That's what we're talking about here. So I think you can start with the first one, management of receivables. Receivables, receivable, the debts that other people owe us, the debts that other people owe us. So receivables, these people are supposed to make the payment at the appropriate time. So the objective of managing these objectives. Why are we managing our receivable? The first thing is to maximize. The first one is to maximize the profitability of the business. The profitability of the business. To maximize the profitability of the business. To maximize the profitability of the business. To maximize the profitability of the business. Two, why do we manage receivable? To minimize the liquidity risk. So these two reasons are very important. To minimize the liquidity risk. The liquidity risk. To minimize the liquidity risk. To minimize the liquidity risk. To minimize the liquidity risk. Minimize the liquidity risk. Yes, to minimize the liquidity risk. So in this case, we in regard to liquidity risk, we know that these are receivable. They should not take too long. They should not take too long to pay the debt, because that increases the liquidity risk. They increase the liquidity risk. Then we should not press them so much. We should not press them so much to pay the debt, because that one can make them go. You see, so we have to know how to balance this. We want to increase the profitability, and on the other side also, we want to minimize the liquidity risk. So we must know how to manage our receivables. We have to come up with a policy to know how to manage our receivable, to make sure that there is a balance. There is a balance. We are not chasing them, and on the other hand, the business is still moving on well. You see, so you have to come up with a neutral policy to help maybe curb these the capturing or the picking of our debts, or redeeming. So you can say that the trade receivable should not take too long. Trade receivable. Receivables should not take too long First of all, understand this too long. It should not take too long because they increase the business liquidity risk. The business liquidity risk. Liquidity risk. The business liquidity risk. We should not put maybe hash condition. On the other hand, we should not put a hash condition. Hash condition. Because this will reduce our profitability. Yeah, once you put hash condition, you'll find that they'll tend to go away, and that one you'll term it as a bad debt. You're going to write it off. That debt you're going to write it off. When they go away, that means you are going to incur loss. So the profitability will be reduced. The profitability will be reduced. So it is very important to know which policy are you going to set to make sure that there is a balance between the two. There is a balance between the two. So when risk is high, or when liquidity risk is high, that means profitability is low, and the vice versa is true. When profitability is high, the risk is low. So we need to know how to balance. So we should have that policy that will favor the liquidity risk and the profitability risk. This is the NB. We should have a policy. Or when I say we, I'm talking of the business, should have a policy. Should have a policy that will favor the liquidity risk, and the profitability. Now this one will solve the problem, and you'll be able to manage the receivable. So it is the work of a finance manager. It is the work of a finance manager to guide on this. So as part of this, you'll be required to come up with a policy that will help to balance this, the risk side, and also the other side of the profitability of the organization. So by the end of the lesson, you'll be able to know how do you set up such a policy that will favor both sides, without being biased on any side, So I think with that, we can look at an illustration, so that we get to understand it well. So the illustration will come from this past paper that was done in May 2019. I think this past paper, we are almost through with it, because I think we have passed through almost all the questions. May 2019, question 2. May 2019, question 2. So if you are there, you can share that question with us in the group so that we proceed. May 2019, question number 2. Let's see how are receivable. How is this policy made to make sure that we manage the receivables? The receivable are debts, the trade debts, the trade debts. So, are you there? Are you there? Are you there? Are you there? It is May 2019. May 2019. You just go to question number 2. It is financial management. Okay, I would like to get a confirmation or a signal whether there's a person who has got that question. There's a person who has got that question. Is there anyone? Is there anyone? Is there anyone? Okay, Raphael is there. It is question 2 part. Okay. Already sent. So, yeah, it is question 2 part, can see part. Part C, this is Chizingo, eh? Part C, someone has already shared. So I'm giving you some few minutes to make sure that you are there. Make sure that you are there. Okay, I want to see another confirmation that you are able to access that question so that I can start. This is May 2019, question 2, part C. This is illustration. Yes. Yes, exactly. Exactly. Thank you so much. So allow me to start. Reading this question as we follow. So let's read in between the lines so that we get to understand what is happening here. Just get to understand. This is May 2019, question 2, part C. And it says, or it reads, in an effort to lower its account receivable balances, Chizingo Manufacturing Limited is considering to switch from its existing no discount policy to a 2% cash discount for payment done by 15th day or after sale. It is estimated that 60% of the customer would take this discount or the discount, and the average correction period is expected to decline from 60 days to 45 days. The company's management projects an increase of 20,000 units in annual sales to 220,000 units at the existing price of 2,500 per unit. So the existing price is 2,500. Additional information. The variable cost per unit is Kenya shilling 2,100 and average cost per unit is 2,300. The company requires a 15% return on investment, that is ROI. The corporate tax rate is 30%. All sales are on credit basis. Assume 365 days in a year. Required. Advise the management of Chizingo Manufacturing Limited on whether to offer the cash discount to customers. You advise this management on whether to offer the cash discount. So here, examiner want us to evaluate whether we are going to have a positive maybe NPV or such at the end of the policy. At the end of the policy, you can see there is an offer. They want to stop the policy that they have and introduce 2% discount. You see, that is an incentive to make sure that you attract these people who have our debt. We want to attract them. And you can see the expected change, estimated that 60% of the customer would take the discount. You see, they will take the discount. That means they will pay. They will pay. And they are paying. You see, there are some conditions. Any policy come with some conditions that for those people who will pay by the 15th day after sale. You see, the way we are trying to pull them to pay, because if you pay by 15th, that means already our cash, our liquidity is okay. And 60% is a good margin. Now we will be struggling with the other 40%. 40%. So we have received the higher degree of debt. You see, so we are trying to minimize the debt which is outside by giving out this discount. But after computation, after some calculations, so that we don't make loss. So that we don't make loss. So that means from the 2% discount, cash discount is just a small percentage of the profit that maybe we were obtaining from that product. See, now we are trying to balance. We share each other. We don't get much profit, and then we lose everything. We don't get much profit, we lose everything. Let's share this the profit, the 2% profit with the customer, and we receive the whole amount, the cost of the product as a whole. So let's see how we can tackle this. Of course, you are going to come up with a statement. And this statement you'll be having the current policy, and then proposed policy. Of course, at the end, you need to see whether there is a benefit, the benefit that arises from the current policy, and then the proposed policy. So have the statement, have your statement down there. Just write down and say, Chizigo Manufacturing Limited. Chizigo Manufacturing Limited. Statement of additional annual financial benefit. Just have it like that. Chizigo Manufacturing Limited. So you can have the first policy here. The first policy here, you can say the current policy. Current policy. Then you can have the proposed policy. And then maybe the benefit. The benefit we are deriving from, maybe from this proposed policy. The proposed policy is the policy that we want to adopt. Is the policy with these advantages to the customer. The proposed policy is the one that we want to adopt. So in this case, the first thing that we need to determine, what are our sales in the current state? What are our sales in the current state before any increase? What are our sales in the current state? Someone. What are our sales in the current state? What are our sales in the current state? What are our sales in the current state? So we shall have a column for sales here, for detail here. No problem. We start with sales. Yes. So you can have sales here. So our current state sale, our current policy, sales ningapi. How do we get our sales? Look at the statement on the third paragraph that the company's management projects an increase of 20,000 units. An increase of 20,000 units in annual sales to 220,000. Therefore, that means the sales was 200,000 units before increase. But now, for the new policy, it will increase by 20. Increase by 20,000. Therefore, the units that was there before increase was 220,000 minus 20,000. So that we get the current one. At the existing price of 2,500 per unit, 2,500 per unit. Therefore, that means that for us to get the sales, remember, to get sales or revenue is price times quantity. And quantity here is the units. Price times quantity. So in this case, we shall take the 2,500 times 200,000, of which let's remove 30 now, because that will be very, very big figure. So what will be our sale? We shall be having 2,500. This is our price times 200. Yes. Now, how much are we going to get? How much are we going to get in that case? How much are we going to get as our sales? Let's see this. 50,000. Can see 50,000 from Raphael. Thomas got to 200. Yeah, thank you. No, now how much is our sales? Putting in mind now, we remove the 3 zeros. Takuwa ngapi? 2,500 times 200. Is it 500,000? Is it 500,000? Someone to confirm that? 500,000. Thank you. 500,000. So have your sales here as 500,000. That is 500,000. What about now sales for the new policy? The new policy, sales. The new policy, sales. It will be now after increase. Okay, Raphael. Okay. But then this is much examinable, so I might take even the whole of the lesson explaining this because this is very much examinable, very much examinable. So if you don't get, I can even repeat 10 times. So we are saying that before the change of the policy, the company, or after change, the company units will increase by 20,000 after change. So this is at the new policy. So the new policy is coming up with additional units of 20,000. And this is adding up to annual units of 220,000. You see, 220. Now you ask yourself, now, if this is after change, this is coming after change, what was the current? Units? What was the current unit? So you just take 220,000 minus 20,000. Now, this is after change. You get 200,000. Now we eliminate 3 zeros. Right, together, Raphaels. So now to get your total sales is 2,500 times the units. Right, together, Raphael. Thank you so much. So now that is for the current policy. Can you compute for the proposed policy? Let's compute sales for the proposed policy, and then we see whether there is benefit. If you pick the current, the proposed minus current, whatever that you get, if it's a positive, that means that is a benefit to the company, So someone to give us the sales for the proposed policy. Remember, the price remain constant. The price is constant. The price, we are not told of changing price. So someone I want to go very slow here because I know most students confused in this question very much. So Rafael is giving us 550,000. 550,000. 500. How I wish I get another person confirming so that we know whether we are moving in the same direction. It's just a matter of looking at what is happening. So my price still remains 2,500. But now my cost, my units change from 200, and then I added 20. So I'll be having 220. When I multiply this, how much am I getting? 550,000. So that is it. 550,000. Now, do I have a benefit? Are we gaining as a company? Or we are losing? When we do that, are we gaining or we are losing? If it is a gain, it is a gain of how much? If it is a gain, it is a gain of how much? Someone. Are we gaining or we are losing? We are looking at now the proposed policy because that is the policy we are trying to investigate how it will, whether it will help the company. To maybe manage the receivable. Are we gaining or we are losing? We had a sale of this. After change, we will get a sales of 550. So I can see there is a difference of 50,000. There's a gain of 50. That is what we are calling benefit. To the company. The 50,000 is the benefit to the company. From this point, we move forward by lessing or removing the variable cost. We less the variable cost because we must subtract the variable cost. What are some of the examples of variable cost? Example of variable cost? Somebody? Can I give a hint? Admin expenses. Admin expenses are example of variable cost. Variable cost. Can you think about it? You need to list variable cost because I can see from additional information number 1, we are told of variable cost. So we less. Just say less variable cost. Allow me to abbreviate this. Now, what will be my variable cost? I'm told that the variable cost per unit is 2100 and the average cost per unit is 2300. Therefore, what will be our variable cost in the current policy? What is our variable cost in the current policy? We are given unit. Let me not move further. What will be the variable cost? Let me see whether you people you are following. Let me see whether you are following this. What will be the variable cost? They are silent. They are silent. I don't know whether they are computing. They are computing. Just check. Just check. Remember, for you now to get the cost, if for the sales we pick the unit and then times price. Still the same happened to the variable cost. Variable cost. You pick units and then you multiply by price before change. Price before change. I think Thomas have seen something. We have units of 2100. We have units of 2100. And then the price will remain to be. The price will remain to be. No. We have cost. We have a price of 2100. And then units will remain to be 200. The units will remain to be 200. We have the cost, variable cost per unit is 2100. 1 unit. What about 2100. So we shall get 2100 is our price for 1 unit. And then you ask yourself, this is for 1 unit. What about 200 unit? 200 unit itakuwa na cost ya ngapi? Cost ya ngapi? You cross multiply and say that it is 2100 times 200. People are giving us 420,000. 420,000. So you do the same. You do the same for the proposed policy. Do the same for the proposed policy. I like when you do it so that you get to understand. You get to understand more of what is happening. More so in this, which is much examinable. I like you doing it so that you are able to know what we are doing. You don't float. You don't float. So what about for the next one? For the next one, of course, it will be 2100 times 220. Remember, the unit will be 220. We are being given 462,000. You're being given 462. You can as well confirm, and then we see what is our benefits. Is there any benefit there? Thank you so much. Thank you so much for that. Is there any benefit? Is there any benefit? Is there any benefit in that? Is there any benefit in that? No benefit? There's no benefit? Okay. Remember, by these are cost. These are cost. So we shall be subtracting. We shall be subtracting. So what's the difference? What's the difference? 506,000. I don't know. Thomas got 506. No, now we are trying to look at 420 and 462. Don't know 506, but Thomas sijui 506 umetoa wapi? Don't know. Yeah, shall be having 4200. And I remember this is a cost. We are trying to subtract this cost. We are trying to subtract the cost. So Thomas, kindly check these. Check these. That is the case. So class, I think up to this point, we can look at the next thing. So if I'm to get the difference, I'm going to get a difference up to this point, 50,000 minus 42. That will give me how much? That will give me how much? 8,000. That will give me 8,000. Then on the other side, for the current policy, of course, this will give me 80. If I can look at it in that angle, it will give me 80. Now, what I need to know, what will be my fixed cost? Because I need to know what is now the fixed cost. What is the fixed cost? What is the fixed cost? I have to take into account the fixed cost figure. What is the fixed cost? The fixed cost. The fixed cost. Fixed cost. Anyone? Anyone? So if I'm to get the difference of which it's not that important, is this is 80,000 cost 80,000, and this is 8,000. So I'm still reducing my benefits for a foreign with the cost. There's no problem. Now I need to know what is my fixed cost. Someone to give me the fixed cost for the current policy, the fixed cost for the current policy, and then fixed cost for the other. And this is cost, by the way. Cost we subtract. Don't forget that even when we get this cost here, we are going to subtract. So who can give me the fixed cost? Remember, we have 200 units at the start. We have 200 units at the start. We have 200 units at the start. Then you ask yourself, these 200 units, I'm going to multiply by what to get my fixed cost, for the current policy. The first one is for the current policy. 200 units, 460. Raphael is telling us 460. Look at what you have been given there. Look at what you have been given there. I have variable cost per unit. And then the examiner has given me average cost per unit. So if I have average cost per unit and variable cost per unit, I have to get the difference first. Get the difference between the cost, the variable and the average. The variable and the average. The remaining will be the cost, the fixed cost. It will be the fixed cost. How much? You take 2,300 minus 2,100. Utabaki na ngapi? Hiyo ndio itakuwa cost yako, fixed cost per unit. The fixed cost per unit for the current policy, fixed cost per unit for the current policy will be 2,300 minus 2,100. This is where the problem was. Most students failed this question because of this statement. So this is giving me 200. Now with this class, this is per unit. So you can give me, you can now give me the fixed cost. With this being the fixed cost per unit, you can give me now the current policy fixed cost. It's very easy. Now I have the price, and then I have units. So itakuwa ngapi? Okay, we are saying that for you to obtain the fixed cost per unit. This is a formula that you should have. You need to obtain fixed cost per unit. I said that better. I'll stay in this subtopic and make sure that we understand what is happening. To get this fixed cost per unit, you get the average cost. cost per unit, U less the variable cost per unit. And that's what we are saying, that you take the given average cost minus the variable cost which you are given as 2100. This will give me 200. This 200 is my fixed cost per unit. This is the fixed cost per unit. Fixed cost per unit. So if I want now to get the general fixed cost, how much will I get for that? Current policy. Someone now to give me the general fixed cost for the current policy. Current policy. This is the essence. Someone to give me the total fixed cost, the fixed cost. You're going to take the price, which is 200 times 200 units. This is going to give me 40,000. 40,000. 40,000. For the other policy, thank you so much. For the proposed policy is 200 times 220. 200 times 220. This is as well give me 44,000. It's giving 44, and this is it's allowance. We have to less this. So if we subtract that, we are going to say that we shall be remaining with something here which will be very important for us. But in this case, now we leave this. We are not interested with all these figures. Whatever that we need here is the benefit that we obtain after we change the policy. The benefit that we obtain, we are interested with this column. Not these are just helping us to obtain whatever that we need. Therefore, up to this point, I'll be having what? 8,000 minus 4,000. Are we going to really get something? Are we going to really get something? 8,000 minus that, but I think there's an information here that will help us to move on here. I have a discount policy, 2% cash discount for payment done by 15. For payment done by 15. That is a discount policy that we want to introduce. That is a discount policy that we want to introduce. So for this discount policy, for the discount policy, I want us to see how do we compute the discount policy. How do we compute the discount in this as far as this question is concerned. So we have 2%, and whatever that we are expecting change in will be 60%. They will convert 60% of customer will take the discount, the 60%. And they are taking this discount after change. So we are going to look at these percentages. It will reduce our sales. 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 So can you compute for me? Can you compute for me the discount amount? The discount, and it will be we are going to less that. It is going to reduce our sales. Therefore, we need to know how to compute that. So in this case, we have 2%. In this case, we can have 4,000 here. There is a total here to reduce. So discount, less discount. So class, the working, I can do it maybe separate. Can do separate. No, hii swali haiwezi kosa kwa mtihani. Hii swali haiwezi kosa kwa mtihani. Kwa hivyo, you see us taking much time here is worth it. So discount is, we are computing discount, the 2% and 60% converting on 550. So it will be discount. It will be 2%. We are giving that. How many will convert? How many will pick the discount? 60%. And where are we getting it from? From sales. 550 after conversion. So what is our discount? What is our discount? Someone to give us the discount there. Someone to give us the discount. Someone to give us the discount at that juncture. Discount yetu ni ngapi? Discount yetu ni ngapi? Discount yetu ni ngapi sasa? Discount yetu ni ngapi? Ai, wamesahau tena. Just compute that. Pick your calculator and see. 6,600, 6,600, 6,600, 6,600, 6,600. Okay, 6,600. We are giving a discount of that. So I'm remaining with that 2,600. 2,600. But now we have to charge tax here. We have to charge tax. We less tax. Tax 30%. What is 30% of our 2,600? What is 30% of our 2,600? What is the 30% of our 2,600? Of course, this one, remember, we have a benefit kidogo, tena tumetoa, so tumebaki na a negative. No problem, no problem. Let's move on. So what is 30%? We pay tax on here. What is 30% of that? And then we look at the opportunity cost of this. Opportunity cost of this. 30% 780. So we are lessing 780. And then we have to find our opportunity cost. Opportunity cost. Now, computation of opportunity cost sometimes become disastrous. It become disastrous. Now the information that is remaining is the one that will help us to compute the opportunity cost. Is the one that will help us to compute the opportunity cost. Examiner had given us dividend payout. We have a lot of information there that we have not used. Okay. No. I've looked at a wrong question. No. All sales are on credit basis. All sales are on credit basis. Assume 365 days in a year. Therefore, we need now to compare and compute what we have here under proposed and the other unproposed policy. So how do we get annual credit sale? How do we get annual credit sale or average receivable? How do we get average receivable? I think from the ratio topic, we had this. Average receivable. How do we get average receivable? How do we get average receivable? Remember, we are starting with the current policy. Current policy. This is 6,600. Current policy. How do we get average receivable? Who can really remember? Who can really remember this? Average receivable. Average receivable. I give you a hint. Annual credit sales, iko mahali. Annual credit sale, iko mahali. Okay. Can you remember? Can you remember something you were saying? It is receivable. Receivables over annual credit sales times 365 times 365, isn't it? Annual credit sales times receivable period divide by 365. I don't know whether you can remember. What is our receivable period here? Receivable period is 60 days. Hope you can see. Receivable period was 60 days. In the current policy, it was 60 days. 60 days. Look at paragraph number 2. It is estimated that 60% of the customer would take the discount, and the average collection period is expected to decline from 60 days to 45. So for the current policy, we are going to use 60. For the other policy, after change, now the days are reduced. The days are reduced. Are we together? Hapo ndio watu ukosea sana. Are we together up to that point? Are you getting that statement? Are you getting the meaning of that statement? Class, are you getting that there will be change of days of the collection period? There will be change of the correction period as far as this is concerned. Are we together? Are we together? Are we together? Before we put down something. Raphael, you're together. You need to understand this, because if you fail to understand this, it will become difficult to interpret the question. It become very difficult. Remember, this is helping us now to compute the opportunity cost. Opportunity cost. Opportunity cost. So in that regard, we can say that to get the correction period, the average receivable, we are going to take the annual credit sale, we multiply by the correction period, then we divide by 365. So to get our receivable and our current receivables, we are going to pick the annual credit sale. Let me just put it in word. Sales, of course, under this policy. Then you multiply this one by the correction period. Then you divide this by 365. This formula means a lot. This means a lot. It means a lot. So in this regard, I can take, I have sales, annual credit sale. We are told to pick all sales that are on credit. Then I multiply this one by what I have as a 60. The payment was through 60. Then I divide by 365. How much am I going to get? How much am I going to get? How much am I going to get for that? How much am I going to get? How much? Someone very fast. Tapata ngapi? And remember, you're doing the same for the, you are doing the same for the other policy, which is the proposed policy. So for the proposed policy, but now these are, we shall be using the difference in days. Proposed policy. Proposed policy, you say the 550 is our sales. Then we multiply by the 60% are the one who we pick that. The 60%. Then times 15 days. 15 days. 60 minus 45. Then divide by 365. Then give me the figure. They have gone silent. 82,191.78. 82,191.78. Many thanks. Then the next one, give me for the next one. This is now for the proposed policy. This is 550,000 times 60%. 60% are the one to pick to take the discount. Then times 15. The number of days that it has reduced with is 15 days. 15 days. Tapata ngapi hapo? Reduced na 15 days. 13,561. 13,561. 561. So you can see point something, 0.64, 0.64. You can see the change. You can see the change here. You can see the change here. We have 82, 191.78 from the first policy, the current policy, and then we have the proposed policy is giving us 13,561.64. Now, do we have a return on equity? Yes. Yes, we have return on investment. We have return on investment. Therefore, we need to pick, we need to see what is the opportunity cost when we look at the difference between the two. What is the opportunity cost? What is the opportunity cost? But before then, I know that I have taken into consideration the 15 days. I've taken into consideration the 15 days. Have I gone ahead taking into consideration the 45 days for those people who will not pick the discount? For the people who will not take the discount, I need also to take into consideration that, because that will be very, very important. The people who are not going to take the discount. The people who are not going to take the discount are 40%. So the people who are not going to take the discount are 40% of which policy? Which policy? Of the new policy. The new policy 550 times 45 divided by 365. How much am I going to get? How much am I going to get? How much am I going to get? Without discount now. This is with discount. With discount, 13,561 is with discount, and then the other one was without discount. So how much do we have without discount? And we need now to pick that, and it is the one that will give us the opportunity cost in this. Without discount, the opportunity cost. Where now do we go? Where now do we go to? How much? How much is this? How much is this? 27,123. 27,123 according to have you multiplied by the 45? I don't know whether we have 45 days. I wish we have two people confirming this. I have 27,123.28. 27,123.28. Thank you so much. Thank you so much. So for the new policy, we have two items. We have two items. Sum the two. So I'll be having 27,123.28 plus 13,561.64. Now you get the total. How much is the total? Thank you, Thomas. Total ya hizi ni ngapi? So that now let's start from our from what we have here as the current policy. Total of these two, 4684. So I have 82 to get the opportunity cost is 82, 191.78. I subtract whatever that you're giving me, 4684.93, 4684.93 times my ROI. Return on equity was 15%. Whatever that you get here, you multiply by ROI. So how much are you going to get? How much are you going to get at the end? And if our total here is a positive figure, if our total here will be positive, we accept. We say that these people should go with the new policy or pick the proposed policy. If it is a negative, they should not restrict, or they should not move to the proposed policy. So give me the figure here. That is that you first of all work inside the bracket, then you multiply by 15%. The return will be 15%. Utakuwa unapata ngapi? Pata ngapi? Sijui utapata ngapi pale? 62.26. 62.26. Now can you work this? 62.26 minus this. So is in minus. Is in minuses, then give me answer here. Utapata ngapi? Rafael, today you have picked it, yeah? You have picked you have topped the game. You have topped the game, and that is good, huh? That is good. So give me the figure at the end and see how to advise this company. I would wish that you go and repeat this question 5 times. 5 times. So that you get the concept. Kindly. Hii ni examinable sana. No wonder unaweza kuta unapata 4406 according to really? Hapana. Rafael, for the first time I disagree with you. Just check 2846. Yeah, because this one already nikichukua hii na hii inaingia kwa 3 something. 28. Thank you so much. 46. So how do we advise? We have a net a benefit. We have a benefit, a positive benefit, a positive benefit, a positive benefit. So how do we advise these people of Chizingo? They can adopt the new policy, for they are going to get the benefit of 28.46. The benefit of 28.46. This is a good amount, by the way. If you add your zeros, it's a good amount. It's a good amount. 28,46,000. So yeah, that's a good benefit for the business. That's a good benefit for the business. So are we together? Are we together up to that point? Are we together? Kwa pamoja Bilha, Glenda, Chalamba, Esther Muchindi, Chris Duta, Hilda, Meli Wangoi, Patience A12, Rafa, Techno, Thomas. Tuko pamoja. Tumeelewa. So go and try this question as many times as possible. Go and try this question as many times as possible. Very much examinable. Yes, very much examinable. Very much examinable. Very much confusing. Very much confusing. Very much confusing. But once you understand, the easiest. Once you understand, it is the easiest. So I think that is the end of that. That is the end of that. Let's look at something else. Let's look at something else. Something else. Okay, we can look at some of the terms that will be used. Some of the terms that will be used here. Yeah, some of the terms being used, which are good for us to note. Examiner will use some terms in such questions. Yeah, it's good you just go and revisit it. It's always good to revisit it and then try and search from all those past papers that you have. Try doing some of these questions. Try doing some of these questions. At this point, I expect that your revision book, exercise book, is almost full. Revision exercise book should be full at this point. Should be full at this point. You should be buying the another one. You should be buying another one because it has a lot. It has a lot. You have to do a lot. You have to do a lot. So terms to understand. There are some of the terms to understand. Terms to understand. So the first one is a credit policy. Credit policy, these are rules that are these are rules that participants must adhere to before credit is extended to him. Before credit is extended to him. You're told maybe you're going to pay 10% of the principal amount or the borrowed amount. You are going to come with guarantors. You need to have a logbook. You see, those are some of the policies. You need to have a logbook. Come with the title deed. Those are some of the policy before you get that loan or that credit. That credit. Then credit standard. Credit standard. So for the credit standard, this is a criteria available. Criteria available. Or condition put in place. Or condition put in place. Condition put in place before credit is given to the customers. Before credit is given to customers. Great. Then we have our credit terms. Credit terms. You're going to meet these terms. These are terms available in settling of credit balance. These are terms available. Please do me a favor by repeating that question hata kama ni mara mbili without looking at it. Tafadhali. Available in settling of credit balance. In settling of credit balance. Great. It is the period offered to credit customer. Kama ile tumeona wameambiwa 15th day. Period offered to credit customer. Great. E.g., for example, if you see something like a credit term of 2/10 net 30. What does this mean? This is very interesting. Credit term, you are told that it is 2/10 net 30. There will be, this is the interpretation, you will be given 2% discount when you pay on or before 10 days, after 30 days. May you are writing that. Oh, sorry. Oh, sorry. Today I've written very tiny writings. I don't know why. Today I've written very tiny. Sorry for that. So the interpretation here to represent the discount promised. Hope it's visible, Esther. Esther, to represent the discount. 10 represent the period of discount. Period of discount. Lakini uzuri naongea, at least you can connect. Esther, are we together? 30 is the credit period. 30 is the credit period. 30 is the credit period. That is the interpretation. That is the interpretation. That is the interpretation. So that means all customer must pay within a period of 30 days. You see, that's now the credit period given for the overall customers. Those customers who have maybe picked goods on credit, 30 days. They must pay within 30 days. But there is a discount for those customers who pay in a period of 10 days. In a period of 10 days, they are going to get a discount of 2%. Sometimes the examiner will use this term. Tell you. So he will not give you the, you see, for the question that you have done, we were given 2% discount, 2% discount. This is directly given. Even the number of days, 60 days. See, 45 days. In this case, examiner will give you information like this. So you need to understand what to represent, need to understand what 10 represent and what 30 represent. So that interpretation is very important as far as any question is concerned. So that is it. Then we have the correction effort. Correction effort. Correction effort. With the correction effort here. Does it mean? So correction measure put in place to correct outstanding balance. Measures put in place. Measures put in place. Measures put in place. Let me try to enlarge my to correct outstanding balance. To correct. Correct outstanding balance. For example, we can have a measure like a phone calls, email, either email, you can texting or short SMS, text, SMS. You can do that. Debt shaming. Why? This is hatari. Debt shaming. Some of the these apps, they use these. Wanapeleka CRB. CRB, debt shaming, ama wanapigia all the contacts in your phone book. They just call all the contacts in your phone book. Have you ever experienced such? Have you ever experienced such? Debt shaming. Debt shaming. Debt shaming is a method of is a correction measure or effort. They can use factors, legal suits, and so on and so forth. All those are correction factors or efforts. They are trying to recover their money. They are trying to recover their money kwa sababu umekaa nayo sana. So they need to find ways to recover their money. So class, there's another illustration here that I would like you to guide me very fast. Guide me very fast because you are good student, and I know we shall be done with that receivable concept. Shall be done with that receivable concept. So the illustration is coming from this past paper of November 2019. November 2019. I don't know whether. Just check November 2019 question number me to see this. Just go to November 2019 first. November 2019 first. We pick it from that point. That would be our pick point. So if you get it, can share with us. Can share with us. A volunteer now to take us through this before I choose. This is the who now. Grace Duta. Grace Duta. Is your background okay to take us through that question? It's a good question, by the way. It's a good question. Sasumua. Sasumua. If your background not okay, just indicate and we move. But if it's okay, I can unmute you and I can unmute Grace Duta here. Ask to unmute. Yes, I'm asking. Yes, so Grace Duta, you can proceed.
Okay, good morning.
Yes, morning too.
Sasumua Limited is considering a review of its credit policy as a way of enhancing its working capital management. The following information relates to the company. Annual sales amount 6 million. Credit sales are 80% of all sales. Bad debts average 3% of all credit sales. Average collection period for debtors is 45 days. Gross profit on sales is 75%. The company's cost of capital is 12% per annum. Terms of credit sales are net 60 days. The company's credit manager is recommending a review of the credit policy of the company. The expected outcome of this action will be increase in total sales by 40%. Credit sales will be 60% of all sales. Average collection period will decrease to 30 days. Bad debts will increase to 5% of credit sales. An additional part-time credit consultant will be hired at 500,000 per annum. Gross profit margin will increase to 80%. Terms of credit sales will be 5 out of 15, net 45. All credit customers will enjoy the 5% cash discount subject to the terms. No change is expected in the firm's cost of capital. The tax rate is 30%. Required. Advise the company on whether to adopt the revised credit policy.
Thank you so much, Grace Duta. You have taken us very well. Thank you so much. Thank you so much. So that is the question. That is the question. That is the question. You can see the way the question is being framed, and it's very much examinable, class. Very much examinable, and hence you should be familiar with such things. So you need to do more practice. Also, when it comes to receivables, they need you to have this concept. They need you to have this concept of a receivable. How do you manage? How do you manage receivable? Because receivable can lead to the failure or the fall of the company. But if you know how to manage, you can even secure a job, by the way. With this knowledge, you can secure a job because you can be able to advise the company, many companies, on how they can manage the receivable without maybe using harsh conditions to maybe throw away or send away the creditors. So let's see how far we can go with this. But because you have a clue of what is happening, I wish that we finish this. It can be very good. It can be very good. So this is Sasumua Limited. they are also considering to review their credit policy. Most companies do this. Most companies do this. So as well, we have annual financial benefit or cost. That is the statement. Sasumua Limited just have this November 2019. This is illustration 2. Let's be very fast. This is question 1, question 1B. So as usual detail, current policy, what is the mode? Hakuna maneno hapa ati kusema there's change. No, there will be proposed policy. Hii ndio format. Hata ukipata tu hii swali, wewe kwanza anza na format. And then hapa tuko na benefits to cost. Through cost. Kwa sababu unakuta kuna cost pia. There are some costs that we are incurring. So, let's start. What is our sales? What is our sales for the current policy? Very fast, class. Allow me to utilize the remaining 20 minutes to finish this. It can be very good. And it will give you much knowledge or wide knowledge to be able to venture in other areas, because there's a concept that is captured here that was not there in the other question. So I like it when I use more illustrations to help you capture it correctly. So can you give me the sales for that? Remember, I'm starting with the sales for the first the current policy. The sales for the current policy. And I'm given this. Given this. Check and give me the sales. Thank you so much. So my shillings will be in 1,000. Of course. That is very good. And you should be very, very active on this to make sure that your mind capture. So sales, it is 6,000. Excellent. What about for the credit sales are 80% of all sales. What about for the next one? The sales for the next one. The next one, for our proposed policy, there will be an increase by 40%. Look at the paragraph 2. After where we have the company's credit manager is recommending. Now these recommendations are for the proposed policy. The other one are for the upper sasa examiner at least separate. So you can see for the proposed policies go down there, and then the above there is for the current policy. So I'm told that there will be an increase of sales by 40%. So can you give me the sales for the proposed policy? Give me the sales for the proposed policy, then give me the benefits. Let's move very fast. 8,400. Thank you so much. Benefit here is 2,400. Hope you can see that. So to get this, we have said that 40% or 140% of 6,000. Mmoja anaweza sema hivyo atapata hiyo, na mwingine atakuja aseme 40% of 6,000 plus 6,000. Sasa sijui hawa wawili watapata the same thing. Are they going to get the same thing as we are getting here, 84? Just confirm. So that is the way you think about this. Then from that point, now we have a benefit of 24. We have a benefit of 2,400. We move to the next point. We are told that gross profit on sales is 75%. Because we are moving chronologically, we have sale, gross profit. Because we don't have anywhere cost of sale, so tunaenda kwa gross profit. We are told that gross profit is 75% of sale. So can you give me gross profit here? The first policy. current policy, the gross profit. Sasa hii kitu ni rahisi sana. Gross profit. Sasa nipatie tu gross profit ya kwanza na ni 75%. 75%. Sasa simpatie hiyo. 4500. 4500. Aha. Gross profit for the gross profit margin will increase to 80. I'm looking at the other side of the question for the proposed policy. So it will increase by 80%. Can you give me the gross profit for for our proposed policy? Gross profit itakuwa ngapi? Is it still 75% of we are told that profit margin will increase by to 80%, to 80% gross profit. So from 75% to 80. Now for our proposed, it increase to 80. So what is 80% of 8400? What? We will examine is a harsh one. It's a harsh one, but a good one because he is trying to elaborate for us. So what is the gross profit for our proposed policy? 6720. That is 80%. Depending on what we have been given. We are told that it increased to 80 from 75 for the current to 80 for the 6720. That is where we are getting 6720. 6720. Great. Now give me the either the benefit or cost. In fact, these are benefit. How much? How much is the benefit here? Benefit 2200. Sasa hapa ni ile hali ni kama ile mbio ya relay whereby unakimbia ukiwa na mti, unakimbia ukiwa na the stick, you give to the other person. You give to the other person. So the moment I come from sale to gross profit, I now forget sales. I move down to gross profit. So from here, from this point, I disregard that 24. I move with this. I move with the sales. I move with the sales. So from that point, I move to the next one. I'm told something. Nafuatilia tu hii kitu vile imejipanga. I'm told that bad debt average is 3% of all credit sale. Benefit to 2220. Thank you. 2220. Thank you so much. Raphael. I'm told that bad debt average 3% of all credit sales. Bad debt average to 3% of all credit sales. Sasa nataka niambiwe credit sale ni ngapi? I'm told that credit sales are 80% of all sales. Ona vile ananichanganya akili huyu examiner. Anachanganya akili lakini still ananielezea. You see, he's making it easy for me as well as confusing my mind. That bad debt average 3% of all credit sales. What is my credit sale? Credit sales are 80% of all sales. My friend, such a statement confuses very many students. Already Raphael has done something. Let's see whether your interpretation is right. Let's see whether your interpretation is right. We are told bad debts is 3%. Yes. Credit sales are 80%. Yes. And then we are talking of 80% of sales. Can you tell me whether you get bad debts or bad? Bad debts. How much are you getting? Someone to confirm that? Someone to confirm very fast. This is a walkover. 144. Thank you so much. Let's look on the other side. On the other side now, we are now here for the proposed. Tunaenda pale chini. Huyo examiner alifanya vizuri kuseparate. Now you know for the current policy ni hii and then proposed policy ni hii. So let's go down. We look at bad debts. We are told that bad debts will increase to 5% of credit sale. Bad debts. So it will be 5% now of credit sale. And what is the credit sale in this juncture. The credit sale will be 60% of all sales. 60%. And it's very, very beautiful. And then my sales are 8,400. So can you give me the bad debt of this policy? Give me the bad debt of this policy. It's very interesting, very, very interesting, and very enjoyable when you get it. 252. Very enjoyable when you give me other gain or loss. In fact, these are costs. These are costs. So it will be a cost. It will be a cost. How much? How much is the cost? How much is the cost? Give me the difference. For the remaining minutes, we can finish. I assure you, we can if we try to increase our speed. Give me the sini hapa 252 ama 144 or loss of 108. Is a cost, just not a loss, but it's a cost. They will incur that cost. They just incur that cost. So let's see whether we have any other cost that we are incurring here. I can see there will be below bad debt for the new policy. Sasa tumeanza kuachana na hizi sasa, because sasa tuna refer to this. Tuone an additional part-time credit consultant will be hired at 500,000 per annum. So there is this consultant. Lakini sasa hii haitakuwa hapa, itakuwa hapa. They will be charged here. So si itakuwa tu hapa. That is a cost, an addition. Then we move and see whether we have another cost here. Discount. Terms of credit sale will be 5. We said 5 inatumika kama nini? A minute. Okay, sorry for that. I think okay, there's someone asking about the 500 kwenye imetoka. You can see someone is asking the 500. Look at the new policy, down there. We are told that there was additional part-time credit consultant will be hired at 500. So Esther, hope you can see that. Then let's move to the next one. I can see the discount. Terms of credit sales will be 5/15 net 45. 5/15 net 45. 5/15 net 45. Net 45. You understand what this means? So they'll be having a 5% discount. They'll be having a 5% discount on that discount will be on the sales. So it is 5% on the credit, on the sales. The sales that we have here, the 8,400. Now, can you get the 5% of the 8,400? And then we are told that the change will be all credit customer will enjoy the 5% cash discount subject to the terms. So tutakuwa na credit customer, and the customer who will pick this on credit, we are told that it is 60%. So we shall be having the credit customer, the number of our credit customer is 60, and then we have the sale as 8,400. And then on the other hand, we shall be having the same, but now on those customers who did not take on credit, they remain to be 40%. So how much are we getting this as the total? The total of this, that will be the discount. The discount will be for that discount. Discount utapata ngapi hapo? How much are we getting? For the first one, 5% of 60. These are for the credit customer. Napata ngapi? Let's try and see how far we can go. In fact, party ile ingine yenye itabaki hapo chini, because I think can you give me this? So that we see. so that we see. Tapata ngapi? Tapata ngapi? Tapata ngapi? Tapata ngapi? Can you compute this? 5% of 60. Ama napatia the same 252. And then this one, 5% of 40. Patia ngapi? 252. Okay. What about the other one? The other one napata ngapi? The other one tapata ngapi? 168. So we have 252 and 168. Ukiongeza hizi mbili unapata ngapi? 168. This is 0 carry 2 carry 420. So that means the discount will be 420. Thank you so much. Thank you so much. Now, from there, I think now we can get what will remain after we pay all these costs. This 2220 minus all these. 2220 minus all these. Remember, we shall stop at exactly 7. At exactly 7. So napata ngapi? Give me that difference. Give me that difference. Then we get tax of that. Patia 2 here. Then we less tax. Tax we are given as 30%. Tax 30%. Pata ngapi hapa? Tax we are given as 30%. Kindly. So nipatia hii. Nataka hata nikiwaachia niwaachie ka kitu kidogo tu. 1192. Get that percent of this. That will be tax. 30% of that. 30% of that. 30% of that. 30% of that. Takuwa ngapi? 30%. 357.6. 357.6. So can we less that to get these are benefits? Benefits. We less that. Less that to see. You can less it before you continue to the opportunity cost. Opportunity cost and opportunity cost yako sasa hapa. Sasa opportunity cost hapa hamwezi shindwa. Opportunity cost. Opportunity cost sasa hiyo mnajua vile tumefanya to get opportunity cost. Opportunity cost. Opportunity cost. So opportunity cost tunaangalia what we have, tunaangalia what we have. Opportunity cost tunaangalia what we have. So we said to get opportunity cost, opportunity cost is equal to opportunity cost is given by annual credit sale over average correction period divided by number of days. So for the current policy ni ngapi? For the current policy, tafadhali, receivable period. Receivable period. Current policy ni ngapi? Si tuko na the given, please, the given we are given 80% annual credit sale ni 80% of 600,000 times 45. We are given the number of days. The period, average correction period here, each and every creditor is 45. So I have 80% of 6,000 times 45. And I was told to take the number of days as how many days? Days zetu tunachukua. Hatujapewa the number of days to use. Are we given? We use 365. Sasa pata hiyo ni ya current policy. This is for current policy. Current policy. Then you pick for the other policy, proposed policy. I can see we still have discount of a discount of 5%, but that one we shall not deal with it. We take the credit sale. The credit sale of proposed policy. Oh, with this time, let me just guide you on this. Finishing it will be easier. So the credit sale is 60% of 8,400. 8,400 times how many days they have to pay within the 15 days? 5 over 15. 15 days divided by 365. That is 4. And then there is the remaining part. So how much are you getting here? Nipe hii na hii. Tafadhali. I can see it's 7:01. So you give me ata dakika ingine moja. Only 1 minute. Give me only 1 minute. Only 1 minute. I've done. Hapa sasa tunachukua direct. Direct. Na tunaona tumepewa 12% as our 12% as our cost of capital. So get me this. Tunapata ngapi tafadhali? Simtipatie tu hii. 591.78. Sorry. Then this one. Give me this one. So hapa itakuwa 591.78 minus hii. Hii ni ngapi? Can waachia at least kitu branded 207.12. This times 12%. You get a figure there. Then you have now to work this. You less tax. Then whatever that you get here, you do the same way we did. Of course, we are through with that. Then confirm your answers in the group. Confirm whatever that you get here in the group. Now you have 1192 minus 357.6. Then this will be a positive. You add it. And then tell me what you are going to get. And then advise the company of this company of Sasumua. I hope that is well understood and it's clear to all of us. So kindly, hapa hivi ndio tu unafaa ujue the way to work. Are we together, class? Are we together? Kwa pamoja, sema tu why. Right? Just why for yes. Why for yes, as we call it today.